Good morning, good afternoon, and good evening to our clients, investigators, and friends around the world. Thank you for joining us. We are very excited to host another session of our Interfor Academy webinars, this time on a topic relevant to many of our clients around the world, one way or the other. Please be sure to ask your questions at the bottom of your chat function. Before we begin, I'd like to let you know that many of you have been asking us for additional briefings from our geopolitical risk division. We've heard you loud and clear, and we'll be rolling out a number of geopolitical risk sessions on strategic targets, the Middle East, GCC, Asia, on an ongoing basis. And lastly, as the truest reflection of the volatility of the markets, we've had to hot swap here. Rick Giovanelli had a last minute client emergency, so we were welcoming his partner, Kevin Stichter, in his place. And some would say we've upgraded. Kevin is a recognized leader and thought leader and expert in this space, so we are not skipping a beat at all. Thanks again to the panelists, and thank you very much to Jeremy for kicking this off. Over to you, Jeremy.
Thanks so much, Don, and it's great to be with Kevin and Ryan. This is going to be a fascinating conversation, as Don mentioned, relevant to such a broad base of people who tend to join us at these briefings. So I'm excited to get right into it. And to do so, let me just introduce our esteemed panelists. Ryan Breen is a partner at KPMG and leader for KPMG's private practice in the Mid-Atlantic. Kevin Stichter is a partner at K&L Gates in the corporate practice with a focus on mergers and acquisitions. How are you both doing today?
Hey, great. Glad to be
Doing
here.
great. Happy to be here too.
Great to be with you both. So I want to start off with a rather broad question, just to kind of get things started, let you kind of opine about the global economy, if you will. Are you feeling optimistic or pessimistic about the M&A outlook and the rest of 2026? And if you could tell me a little bit about why. Ryan, why don't we start with you, if that's okay?
Sure. I would say, being in the private practice and working with a lot of venture-backed and PE-backed companies, as well as a lot of entrepreneurs, I think we always have to stay optimistic. While it's certainly a turbulent environment, we are seeing deals get done. I think a theme of the conversation that we'll have is maybe that shift towards lower volume but bigger deals, and there's a lot of reasons for that we'll get to. But I think we'll continue. Deals are happening. They're private equity who's driving a lot of the deal activity. It's being more selective. There's a lot more diligence being involved, often supported by AI, and there's just a lot more priority put on execution. So the better deals will continue to get done. You're going to see a lot of pulling of large deals, but deal flow will happen, and then we'll get into which sectors are probably going to see more of it. But we want to remain optimistic as we work through some of these turbulent environments impacting the macro.
Yeah, thanks, Ryan. There's a lot of threads to pull there that we're going to get back to. Kevin, what do you think?
Yeah. Well, we have to acknowledge there's some significant headwinds, but I'm still cautiously optimistic for a few reasons. First of all, most of us deal makers, just by our nature, have to be glass half full, thinking that the next deal is right around the corner. So that's a little bit of the mindset of the industry. But, the fundamentals are, if you look beyond some of the geopolitical noise going on right now, which hopefully is somewhat temporary, we'll see. But a lot of the M&A fundamentals are really strong. I mean, debt and equity financing is very much available. We've got a lot of companies who want to take on some new financing. We've got mandates for growth for both public companies and private equity. There's a ton of dry powder in the private equity space. And the tech transformation, although it's causing some disruption, that disruption can also lead to M&A activity. So I think there's reason to be optimistic.
Yeah, thanks, Kevin. I think that sets us up really well. And it also kind of points out why we wanted to have practitioners like yourself with unique insights into the private side of the market. You know, we can all read the Wall Street Journal and different things, but you guys are down in the trenches. So I think this perspective is going to be really valuable. Let's get to what the biggest story is of today, the conflict with Iran. And that's not only kind of shifting global alliances when it comes to foreign policy, which, you know, policy wonks like me follow really closely. I'm really excited to get into what we were just talking about. Your kind of down in the trenches view about how this conflict is impacting deal flow, macroeconomics. We're starting to hear some stories really coming out about shortages affecting the food chain, a lot of really concerning trends. I'd love to hear from you guys on that. This time, let's start with you, Kevin, if that's okay.
Yeah, sure. Glad to. As with any disruption, there's going to be economic winners and losers. The same is true here. I would say overall, it's had more of a negative impact on deal flow, though, for a few reasons. I mean, the obvious one is just the higher price of oil, which is, making it more expensive to, for factories to produce things, for people to ship. And just it flows through every segment of the economy. The other factor that's kind of having a negative impact is just the uncertainty. And so deal makers like certainty, even if it's not good news, if they've got visibility on where things are heading, they can price that into their deals and move forward. But the uncertainty is really a drag at the moment. I mean, again, getting back to the earlier theme of there is still reason to be optimistic because, our hope would be that this gets sorted out in the weeks ahead and that this kind of negative cloud will dissipate as the year goes on.
Yeah. Ryan, what's your perspective on all this?
Yeah, I agree with that. Uncertainty is the biggest deterrent to deal making because it creates these valuation gaps. And so I think one of the points that wasn't touched on just yet was the impact of the supply chain that
Right.
both this conflict in Iran, but then also the related tariff regime that's going on, and what that tariff uncertainty does. One, global supply chains are super complex, so redesigning it takes time. So companies who have responded to the initial tariff regime, it's not like then when the Supreme Court reverses a decision, you can unwind what's already started. It could take several years to reset your supply chains. So when you think about that, if private equity doesn't know or companies don't know what supply chain, what things will cost, oil, interest rate impact, but also then what the tariff regime will suggest, it creates this uncertainty that really creates challenges in establishing an agreed upon price for the deal and shifts again more towards concentration in what's known. And that's why you're probably seeing, you know, these mega deals where there's less uncertainty, the economics are strong, it's easier to price, and then people are willing to pay a premium, but then you'll just see almost like a doggy pile of multiple sponsors get in on the same deal for a larger deal. And so one of the ones and then a shift, I think the war in Iran is also shifting a sector focus. You're clearly seeing a lot of countries, including the US, but also Canada, increase defense spending. So then you'll see more deals get done in defense, but then also infrastructure, alternate sources of energy, and then some of these large transactions that come out of that, like this recent AES. I think they're a public entity that EQT, as well as this other sponsor that I'm forgetting off the top of my head, but they just took this company private for $41 billion. So
Wow.
that's a massive deal, but it's not the traditional type of deal that may have happened a few years ago. So I think that that's the impact of a conflict like that.
Thanks, Ryan. I actually want to stay with questions on the Iran conflict for a second, but I also just want to point out to our audience that we'd love to get your questions. So I think it's raise hand or it's one of the buttons at the bottom there. Please put your questions in there and we'll look to put those forward to Kevin and Ryan. But staying with kind of the cascading effects, we might say, of the Iran conflict, you were just alluding to that, Ryan. I'll go back to Kevin for the first part of this answer, but what are the effects that you're seeing? I know Ryan just alluded to defense spending. Obviously, that's going up. There's a lot in the news about the munitions being drawn down in the U.S. arsenal. There's a lot about drone technology because, if we broaden the aperture on the conflict, we can look at the Ukraine conflict and the lessons being learned there, which are that drone warfare and robotics are going to change the future of warfare. And then, as Ryan alluded to, there's a lot of people, I think, saying now that, hey, once again, we're dealing with the situation in the Middle East and oil and gas prices are spiking. I'd love to get a little bit more down in the weeds on whether we're going to see, you can break out your crystal ball, kind of a growth in green technology, which the current administration has obviously not encouraged. So I'm curious to get your perspective on government incentives, the cascading effects of war. A lot to work with there, Kevin. I'd love to hear your thoughts.
Yeah. Well, I mean, the green technology is an interesting one because you would think that this conflict that has made oil a more scarce commodity would encourage green technology, and I think it does, and it will over time. I mean, I think places outside of the U.S. Are going to be getting a head start probably on the U.S. on that. I think that the U.S. will come around eventually because it needs to. It's good common business sense. So I do think that that's a long-term good play, even though short-term in the U.S. It's got some obstacles. Other things that flow out of this conflict that we're seeing is I think all countries are looking at, not just this situation, but also what's going on with Russia and Ukraine and other conflicts around the globe, and saying, hey, number one, we need access to whether it's weapons or just basic goods and infrastructure, and we need to make sure that we've got multiple sources and a preference for that source being within country or a nearby country or friendly countries.
Yeah.
So there's a little bit of a reordering of the supply chain, that has been a pretty fundamental shift from 5 years ago, where it was just sort of like, well, if we can get it one place and we can get it really cheap, that's great. Like that's no longer the mantra. And so that's leading to a lot of M&A activity to address that issue.
Yeah, that's very interesting. Tying it to kind of the nearshoring trend that developed after COVID, I think is a great point. Businesses react not only to government incentives, but to what's going on in the world and what's going to make the most sense. So I think that's really interesting. Ryan, would love to get your perspective.
Yeah, I would agree with everything that was said, but then also just even double click more on what happens when these conflicts and when neighboring countries decide who to support and how, and then what the United States current president then does as a response to that has big impacts. You've seen tariffs levied on countries in direct response to how the president has deemed the response of a country in the region's behavior. And so I think you're going to continue to see that until this conflict settled. But then also, I think that I can't crystal ball this, but there's some countries that clearly are in a bad place with where this oil crisis has put them, and they're going to be a little desperate to resolve the problem. And I think the impact of China as a savior for some countries, and what does that do to the U.S. economy and risk profile in the future as this AI movement almost shifts the need, and we'll get into this with
Yeah.
investment, but shifts the need from caring about software to caring about the physical assets. And like, you know, it's almost like, yeah, that's great that I heard this analogy. It was once important to print, like if you were a printing press, that was really valuable at some point when you were, but now when anybody can do it, now it's who owns the paper and who owns the ink. And so I think the war for resources is on the come, and I think that that's what this conflict is highlighted, and how the dust settles, and that'll probably drive a lot of the M&A activity and where the money flows, just as we think about the future.
Yeah, I think those are really interesting points. And the kind of over the horizon one you mentioned about China coming in and bailing out these countries, implications on, the dollar as the global reserve currency that could follow. We're living through a real shifting time in global affairs. And this is to say almost nothing about the idea that Iran wants to control the Straits of Hormuz and put a toll on there. And, it seems almost unthinkable, which is why I don't think any of us have brought it up just yet. But in this world with this unconventional, to say it in a nice way, presidency that we have right now, if some bargain was reached in that way, that would undermine and upend, many, many decades of the idea of freedom of navigation of the seas. So it's just an extraordinary time we're living through. Ryan, I'm glad you didn't kind of, steal out the AI question for me. I do want to move into AI, which is, of course, in addition to the Iran conflict, the big thing overhanging, the economy. There are many people who believe that the strength of the U.S. economy right now is, basically on the back of this AI boom. So I'd love to hear what you think of that. And what do just generally speaking, to open it up, and Kevin, I'll start with you. Talk to me about AI and the M&A outlook and anything you want to share about how it's impacting the economy, please.
Sure. Thanks, Jeremy. Well, I was a computer science major in college and actually had artificial intelligence class many decades ago. So
Wow.
it's not a new concept, but it's just become turbocharged because of the vast acceleration of computing power.
Yeah,
But we could easily take this whole hour or a whole week to talk about AI. It's just so
sure.
transformative. But if we narrow it down to the M&A context, I think there's a few takeaways. One from a business standpoint, as you're looking at a target company as a potential investment, investors are stepping back and trying to look into their crystal ball to think, is AI, is it going to help or hurt this business? And, there's some obvious ones that are being helped by AI, such as chip manufacturers and anybody that's associated with building data centers, whether it's the engineering or the construction. And then there will be others that are hurt. We've seen a lot of layoffs in the news that are AI driven, and it does, as Ryan was saying about the printing press. What used to be very sophisticated software engineering, that's maybe becomes more of a commodity than it used to be. So that's one thing that everybody's looking at on the AI front as it relates to the M&A space. Another from the legal or technical standpoint is for these target companies that are looking for investments, are they using AI appropriately? Are they complying with the laws? Europe has typically had more stringent laws in the data protection space than the US has, although now states are coming out and trying to enact different laws that would impact AI. Also ensuring confidentiality of information. So people are very focused on making sure that, their secret sauce about their company can't
Sure.
get out through use of, public AI systems. And also, just that they're overall protecting their intellectual property, things that they're developing, that they have the ability to continue to protect that. And then the last thing I'd mention as it's specific to M&A is all of the players in the transaction space, the public companies, the private equity groups, the accountants, the lawyers, the bankers, everybody is looking at it to say, how can we do deals better using AI?
Hmm.
How can we do things faster? How can we get better information? Maybe make it less expensive. I think the speed is one that's getting a lot of attention in the deal space because M&A is very speed focused. And so anytime one party thinks they can do it better than another, that gives them a competitive advantage.
Are you seeing that kind of speed increase in your work?
Yeah, yeah, yeah. People are looking for results faster because they know that we could all use AI to, shortcut some things that might have taken days that could now potentially take hours.
Got it. Ryan, are you also seeing increased efficiencies in AI? And obviously, anything you want to share about AI and the broader question, we're eager to hear.
Yeah, I mean, I, I echo Kevin because like my mind started racing with all the ways I want to take this. I mean, I think AI adoption from people are paying for licenses in organizations but aren't actually using it. We're engaging with tons of enterprises trying to help them integrate and get their people to adopt the technology because it's not just enough to have AI, it needs to be embedded in your workflow. And that's what investors and deal makers are looking for. It's not just that AI is in your platform. It's like, how are you enabling AI to differentiate your product and get end to end? And so within organizations, AI will only have a bigger impact once it's used more. But if you think about on the deal side and deal speed, I mean, all the major investors are using AI in diligence, which is part of that process. It makes it faster, but it also gets deeper. And so I think that's leading to some of these valuation moats being created, as well as even some tension on just how you can get a deal done, how people are thinking about integration. That's actually, I think, a lot of the diligence that's using AI is thinking about post acquisition integration because that's really becomes a premium to get deals done. Folks are shifting. The old private equity model was traditionally buy, hold, sell, 3 to 5 year period at a larger multiple. There's, operational excellence was kind of like thin out the inefficiencies. Maybe if you're a business that relies on rebates, maybe you're getting better rebate plays, and then you buy it at 5x, you sell it at 8x, everybody wins. There, it's not the same with AI now, and it's forcing companies to really think hard about how are they going to enable AI to drive operational excellence, increase their digital platform, reduce headcount, et cetera, to try and drive value and return capital to the LPs. And so I think, you know, AI is shifting that, and it's also shifting the value from the software and into the actual service. And that's a big dynamic that we see now with SaaS businesses. If you want to be a SaaS business on the future, because if you think about it, you could vibe code, people could download Claude and vibe code and create a product within weeks, potentially that could compete with an existing product that might have taken years. So it's
Right.
also AI is also shifting the priority to proprietary data. And so are you consuming data that someone else doesn't have access to so that only your LLM can run off of your private data
Interesting.
versus what the public domain has available to them? So that's
Yeah.
another thing that we're seeing a lot of.
Let's stick with this for just a second too, and we're starting to get some questions. I encourage people to ask more of them, and there is a question specifically for you, Kevin, on this, which I want to get to in a second. But just to stick with you for a moment here, Ryan, I want to use what I described before. You're a practitioner, down in the trenches level view. Love all the theory, the macro stuff. It's clearly well informed. But let's talk about just valuations here, Ryan. Are you seeing valuations actually change? I mean, you're an audit guy at one of the world's leading accounting firms. firms. Are you and your colleagues kind of like opening your eyes and going, wow, this would have looked different 3 years ago? Tell us what you're seeing with respect to that.
Yeah, and just to establish something about valuation for the audience, not knowing who's out there, but if you think about there's two main ways to think about three, I guess, to value a business. One, it's a third party comes in, sets a price, invests, and then kind of backs off to what the business is worth because the best indicator of fair market value is what someone's willing to buy something for. But then as you're trying to establish your value to then go sell your business or raise capital, it's basically discounted cash flows as the most common. And so if you think about discounted cash flows, you have to project what you're going to make as well as what it's going to cost to make it at its simplest
Mm,
form. So if you're able to drive efficiencies through headcount as well as just costs, takeout that AI can create those efficiencies, then that will result in a net increase in your valuation. However, if you're a business that strategically, like a software as a service, we call it SaaS, if you're a business that was typically valued based off of this annual rate, it's ARR, annual recurring revenue. That was why these businesses were valued so high. You get a subscription, you know you have them under contract for a period of time. There was known cash flows that can be marked against, discounted lightly in a
mm,
cash flow model, so creating big values. So what you're seeing is a market reset on valuation. 2020, 2021, the valuations were crazy. And this will tee you up for another question we might get into as to why the deal flows down a little bit.
yeah.
But it's impacted exit activity because you can imagine if someone valued and invested at $1 billion years ago, what is that new value when that service is not as proprietary as it once was? Those revenue streams are a little bit more at risk. The flow, the supply chain, all these things, they've brought values down in a lot of cases. And so I think that's why we're seeing some struggles to get deals done because if private equity can't return less than their carried interest back to their LPs, so you're seeing a lot of different ways that companies are getting strategic about exits, and we can get into some of the different types of deals we're seeing, but it's not your traditional buy sell model. And I think that part of that's the valuations, which are driven by all these macros.
Got it. Well, if I can torture a metaphor here, just as the US is getting bogged down by Iran, we might be getting bogged down by AI here, but I want to stick with it for a minute because questions are flowing in, and I think it's really important. Kevin, I want to offer you the opportunity to speak about valuations, but one member of our audience specifically asked if you could talk a little bit more about AI policies, and they're wondering about how OpenAI, for instance, keeps changing their user policies. So how can users protect themselves when AI companies reserve the right to change their policies at any time?
Yeah, I know internally we're focused on closed loop systems where we can bring in an AI carrier and run our own proprietary data through it, but not have leakage out into the market of that.
Right.
And so that, for the larger companies, I think that that's the direction most of them are trying to head, and they can build off of the OpenAI models, but we're not just opening up OpenAI and putting in prompts that would relate to you know items we're working on because confidentiality is just so critical.
Right.
And so I think that the focus now is, you know, use AI as much as you can to gain efficiencies, but still the number one objective for companies is making sure that their data is safe and is not getting out there. And so that, that does slow down the adoption at times and can also slow the efficiency as we kind of continue to work through it. I mean, it's also new, right?
Yeah.
And so we're all still struggling to figure out how can we best use this new powerful engine that we got, but not have it work against us. I mean, at the same time, we're seeing these incredible efficiencies through AI. We're also seeing, threat actors in the data privacy and data security space, and they're using AI as a way to, hack into systems easier. So there's definitely a mindset of we've got to be secure.
Thank you for that. No, that's really interesting. I want to just ask one more question from the audience here about AI. I'm not aware of this lawsuit, but I'll put this to you, Ryan, first. Even though you're not a lawyer, it's about a pure firm. Somebody asked, do incidents like Deloitte AI report lawsuits change how financial services firms should think about liability and disclosure when AI contribute to client-facing analysis or recommendations? Kevin was obviously touching a bit upon that. So if you want to build on anything he said or anything related there, and feel free to kick it back to me if you don't want to touch it.
Well, well, I'm trying to understand where the question's getting at. So is it more? I'm not aware of Deloitte's matter
Yeah.
that they're referencing. So I'll attempt to address the question that I think might exist, and then even just double down on what Kevin's saying about the importance of a firewall. I mean, if you don't, your employees will be using AI. It's whether you give them a safe place to use it for your data or whether you don't. And if you don't, then your proprietary information will be readily available for the general population. People's jobs are at stake and they know that they can get the job done better using it. So if you don't give it to them in a safe environment, they will do it themselves. So that's full stop. Now, when we're contracting with client, KPMG just announced a large partnership with Anthropic yesterday. It was biggest news. That I'll pat myself on the chest because like I'm super proud of that relationship. That's going to make us a game changer for tax offerings where it's focused. But the contracting side of that now, the ability to prove to clients that we can keep their data safe, because if we can't prove that and we can't avoid the issue that Accenture had a couple months ago where someone basically reversed engineered a prompt to get at their client data, if we can't protect that, then we lose all credibility. And then you could have the best AI in the world, but if you can't prove to your clients that you can protect their data, and it's not just protected in your firewall, but it's also de-identifying it such that their trade secrets aren't lost amongst themselves, then you kind of lose your status in the ecosystem. So we're putting a ton of effort in towards compliance, data rights, security. I mean, it's the number one focus of our firm. And then just to throw a huge wrench in this whole thing is we don't even want to talk about what quantum's going to do
Right.
for encryption and how that's going to impact data security broadly speaking from what we knew today. So we're actually spending a lot of time on quantum computing and what that's going to do on the next lens because that's that's probably not as impactful as AI broadly speaking, but deeper in terms of encryption, how much quantum will disrupt business.
Yeah. It's funny that you mentioned quantum because the last time we had a K&L Gates partner on, it was talking about espionage and how to go from a spy to being a lawyer. And we reflected upon how quantum computing will potentially upend the world of espionage. It'll upend a lot, clearly. Before I move on from the quagmire of AI that we're lodged into right now, Kevin, is there anything else that you want to say in response to Ryan, or should we just move on?
I'll just add one quick point. One thing that we haven't talked about much is just, we all know that AI can hallucinate and come up with some strange outcomes. One way that we found to be effective in terms of dealing with that is when we've got an assignment related to a target company, we'll try to bifurcate the work into, okay, what's the really important stuff? And those items we'll probably still run through AI, but we'll also have, actual humans, deep in the weeds, making sure it's all correct. But then we may have a secondary workflow where there are things that the clients want to know about, but it's not the key issue or the one of the key issues in the deal. And so there's a little more flexibility that there could be some errors in that work stream. And there we can use AI with less human oversight. It's not zero, but it's less. And what we say to the client is, for this work stream, we think that this is directionally correct, but any of the individual facts or conclusions might be a little off because we haven't fact checked everything. But we found that companies find that really valuable because they're getting the key answers that they need. And then they are also getting, kind of directional input on other things that are helpful that just don't need the same level of, resources and cost and time devoted to them.
Yeah, makes a lot of sense. And obviously, as you both alluded to, we could probably stick with AI through this entire time we have together.
Yeah.
But I'm going to try to push us forward here. Kevin, I'll stick with you to answer this two-part question that I have here. JP Morgan noted in a report at the end of 2025 that it was a year characterized by a shift towards larger deals. Is that still true in 2026? And is it a K-shaped, quote unquote, M&A market, as many say? And then what does this mean for middle market deal makers? And is the divergence between large and small deals something we should expect to persist?
So it has carried over to 2026. And Ryan mentioned some of the rationale for that, just that greater certainty at the top end of some of these deals. I think we also have to keep in mind that, those large, multi-billion dollar deals among household names, that's what grabs the headlines on the Wall Street Journal or
Sure.
other publications. But I mean, the middle market really drives this country. And the vast number of deals typically, and still true today, if you look on a deal count as opposed to dollar volume, are middle market deals. Now they have been lagging a little bit because of all the market forces that are out there that we've already touched on. But there's just no way that will persist because there's just too many middle market businesses, and the
Yeah.
country is so dependent on the middle market, and it's such a driver. So I do think it's sort of a temporary, I hesitate to even say flight to quality because middle market companies are quality, but flight to those big names that people just feel comfortable with. And it will come around.
That makes a lot of sense. And Ryan, over to you in a second. And then we're going to move into private equity just after this. But Ryan, what's your view on those two questions?
Yeah, I mean, the mega deal is still here. Just some loose stats to quote. I mean, we're at volume of deal flow in the globe is at 5+ year declines. So like the actual number of deals getting done is lower, and it's for all the things we alluded to, but it ties into like private equity. If you think about the market landscape right now, the number of public companies has almost been cut in half over the last 20 years
Hmm.
as private equity continues to take over. AES is a great example, a take private scenario. There's less regulation in the private markets, and a lot of management to earnings versus doing what's right for the business and all that volatility that the public markets creates. So there's a lot of money in the private equity. Part of the reason, in addition to what Kevin pointed out with the mid-market disruption, is just that lack of exit opportunity that's persisted due to the valuation spikes and the uncertainty with a lot of these supply chains and tariffs. People just haven't been able to comb through and create the certainty yet. So if you're sitting here as an LP or a private equity sponsor, for example, and you need to have a win in order to then go reinvest in the next, but your valuation is too high that you're carrying the company at, people, instead of just selling those businesses and redeploying, are thinking of creative ways to monetize and reset the value. So one example you hear a lot of people call a carve out. So maybe you're taking an underperforming part of your business, maybe you can sell that at more of a discount. Maybe that creates better cash flows for your remaining business to then elevate. So you're seeing a lot of carve outs take place, people bolting on certain solutions to build out their profile of their business and lean into strengths versus platforms, which was always, the case. You wanted to have a huge platform before, but maybe now it's more leaning in to what you're doing well at. So I would just say the mid market needs to come back for all the reasons Kevin mentioned, but it's going to be a slow burn while we continue to have all these headwinds created by all the uncertainty that we alluded to before, and we need the exit market to improve ultimately.
Yeah, no, that's great, and I want to build it. I want to talk a little bit more about private equity, and I kind of have a two-part question here. I'm going to start with just the first, and then I'm going to talk a little bit about backlogs and exits. But private equity firms are sitting on an enormous reserve of undeployed capital, and the pressure to put that dry powder to work is intensifying. Where are sponsors finding the best opportunities right now, and how are they navigating the gap between buyer and seller price expectations? Kevin, could you start us off there, please?
Sure, sure. We do a lot of work in the private equity space, and I think the private equity firms have forced to get a little more creative, and that's both in terms of the new platforms, add-ons, and exits in all respects. So for the new platforms, they are looking at, they're really ramping up their proprietary deal flow, where they're making their own connections directly with companies as opposed to just participating in broad investment bankers sponsored auctions.
That's interesting.
We've also seen a lot of the larger funds go kind of downstream, down market, where they're doing smaller deals than they would ideally like to
Mhm.
be doing, but just so that they can continue to have a hand in the market and get some deals done and identify companies that may be smaller than their target size now, but have the potential for large growth to get to where they'd like them to be. We're also seeing private equity groups focus more on add-on acquisitions where it doesn't have to be, real large, but it can, as long as it's accretive, then it's a good thing. Now, these strategies do end up sometimes taking more time. And so, that's one of the reasons we're seeing the hold period for private equity groups at an all-time high right now,
Mhm.
also reflecting, just this backlog of they're having trouble finding exits. But then on the exit side, we're also seeing lots of creative solutions. Ryan mentioned one in terms of carve outs. Some of the others are, just a traditional dividend recap. But we're also seeing more continuation funds where it'll be sort of a partial exit for the private equity group, and they'll bring in some new money and maybe have a new fund and invest in it,
Yeah.
so that there could still be some liquidity gain for LPs, but not having to sell the whole thing at a time where the valuations are maybe not quite what they would hope they should be.
Yeah, that's let me stick with you just for a second. Excuse me just for a moment, Ryan. I just want to stay with that because the second part of what I wanted to talk about were exits. So you just spoke about it, but I want to ask you, and Ryan, I'll ask you to speak about exits then too. But what about the IPO market? Is are we going to see a break? There's a backlog of companies I think wishing to access the IPO market. Maybe I'm wrong about that. What do you think about that as an exit now?
Yeah, I mean, I think that's going to be a great exit for, a select number of largely tech-focused companies. I don't know that it's the solution for, if you looked at all of the private equity-backed companies that are out there in the US right now, the IPO market is still going to be the right exit for a pretty small percentage of those.
Yeah.
But it is improving. It's on the uptick.
Yeah. Thanks for that. So, Ryan, over to you. Basically about, once again, opportunities within the PE space and what you have to say about exits.
Yeah, and I'll even just talk about the IPO market at first,
Sure.
and it's going to be very sector specific, and it's based on the dynamics of that particular sector. So it's important for the audience to understand while biotech investment or IPO markets could be back, that's not going to have the same suggestion for what tech could be. We're going to have some record IPOs this year with Anthropic, OpenAI, and SpaceX. So the valuations of what you'll see have gone public will be massive, but then the volume will be down. And so I still think so. The IPO market, the bar has raised. It used to be growth at all cost, and this is for private equity investments too. Let me get my revenue growth. Let me show the hockey stick. That's all that matters. The game has changed on that. It's get me to cash flow break even. It's how quickly can you start churning. It's customer retention. It's customer acquisition cost analysis. It's really the pressure to run an operational excellent business has just raised because once you go public, the markets aren't favorable to missing earnings. And so and then all of a sudden value could just be wiped out. So I think people are just more cautious about going public until they're more mature, whereas businesses were going public before because capital was free. So that's
Yeah.
the other dynamic. Until interest rates drop, going public just isn't going to be the optimal play for businesses to return value to their investors.
Yeah.
And so it's almost seen as for a lot of companies the last resort as opposed to 20 years ago it was like the golden goose. So we've seen a shift. People are running dual paths because the process for diligence and the process to get your business ready for an exit, whether it be public or private, is very similar. So Kevin and my firms are both working with companies on the same level of rigor to get ready for both events. But if you talk to an owner of a business and he gave you the honest opinion, it's probably he's daring to go public to try and drive up value for a private exit because that'll
Yeah.
return capital quicker. And so I think that's the dynamic we're in. In biotech specifically, you'll see more of them go public because it's there's not as much the risk is in the science. So the companies will go later in terms of their phase of development, closer to a commercial product launch or closer to data in phase three. Whereas like you used to see like phase one companies might go public and think the public markets will fund their development. You're seeing that lessen, but there's still robust deal flow happening in life sciences due to
Mhm.
this concept of the patent cliff. I spend a
Yep.
lot of time in life science, so I tend to focus more on the conversation of that. But there's a patent cliff coming in the healthcare sector, which is going to increase M&A activity for the remainder of the year and beyond as large pharma needs to replenish their pipeline of products as generics become available. So all that to say, um, I think IPOs just aren't as sexy as they once were, and hopefully they will return one day. And I think that there's a lot of regulation trying to put kind of in motion to try and make that a thing. And then I'll just say the other thing is sector specific private equity, and Kevin already alluded to this. They're coming down channel. There's a lot of that EBITDA aggregator model with growth funds. So you might see a private equity open up a growth fund. Maybe they're now acquiring mechanic shops, like really low. But then maybe these are million and a half cash flow businesses, but now suddenly they can add them all together and aggregate some EBITDA and put some technology into their and do that operational excellence that I was talking about and create value there. So we're seeing new sectors, HVACs. Like how many people have had an HVAC come over to their house now? Well, all of a sudden they're private equity backed. So you're seeing these new industries that were traditionally family owned, mom and pop getting into private equity. And then we're also seeing an increased amount of money pouring into defense tech, because of what we talked about with the global unrest, but then also renewable source of energy, infrastructure, data centers. How do you how do you invest in what's going to be the resource needed to drive a lot of these technology solutions that are going to be available to everybody? And then lastly, I guess we're seeing a lot with robotics, because robotics is that perfect balance of AI, technology, but also defense tech, infrastructure, autonomous driving, like all these things, semiconductors. So that's we're seeing the shifts more into those industries that are going to be dominant in terms of funding in the future.
Yeah. Thanks so much to both of you for that. We are looking at the finish line here a little bit. We got less than 10 minutes to go and want to make sure we get everybody done before the top of the hour. So maybe think about the final questions as the lightning round, the quick answers to some vexing questions that you probably could spend a lot more time with. So sorry for that challenge, but I have a couple other questions both from me and the audience. So appreciate the brevity here. I'm a China guy, so I want to ask you about President Trump's recent visit to China. Doesn't appear to me that he achieved very much other than, acting like he was the best friend of Xi Jinping. But I want to hear about how you're viewing China right now in your work. We've seen a drastic reduction in businesses wanting to do business in China. What does it look like from your end? Kevin, if you could start us off.
Yeah. Yeah, no, it's getting a lot of attention. Any target that's got operations in China or if we're on the sell side and a potential buyer has any kind of China related investment. I mean, we are sometimes screening those, if we're on the sell side, screening those potential buyers out early in the process because we
Wow.
just don't want to spend time on something that we think is going to be problematic. We're
Wow.
also seeing both in the US and abroad just greater scrutiny by the government agencies that have to approve deals. Here in the US, it's a kind of a black box organization called CFIUS, but any deal that has any kind of national security concerns has to be run by CFIUS, and it runs all the way up to the president. And so we're very we're more cautious about those deals because there's greater risk of them being able to get through.
Ryan, over to you.
Yeah, and I mean, China's complex. I think there's a lot of things China's done really well to create a competitive advantage over the US in the last couple of years, and I think that we're gonna hopefully have to do something differently. That they've created a very robust regulatory environment. They're moving through regulatory environments quicker than we are, particularly in biotech. So you've seen a big shift to partnering with businesses in China for biotech because of that regulatory environment. They're also, I read an article yesterday or this morning from PitchBook talking about how private equity is getting back into China a bit because of
Really?
the what they're seeing in terms of productivity with energy. They're producing a lot of energy at a lower cost than we are, and when you think about AI and the movement, that's the game right now. Who can produce as much processing power as possible at the lowest cost? So I think there's a lot of resources available in China, and just there's certainly over the past few years have become a much more competitive country to the US. Now, we're seeing a ton of inbound activity because Chinese businesses want access to the US economy. So you're always going to see that natural shift to these companies trying to come into the US, access US capital. But you're also going to start seeing potentially a shift if the US exit environment's not good enough and the Chinese environment is better, then you might see some of these businesses trying to access the China market to get some exits. So
Got
a
it.
lot to come, but I'm personally nervous about the competitive landscape in terms of what the US has given up to China over the recent years due to some of our decisions that we've made about renewable energy, biotech technology, some of these things that we were always lightning years ahead of everybody,
Yeah.
the gap has closed.
Yeah, I'm concerned about all those things. Also, the industrial level of espionage, corporate espionage that we have seen at Interfor for many decades, which we've helped our clients with. And wow, it's extraordinary. So, two more quick questions. Quick being the optimum word here. I want to, Ryan, I'll stick with you because you brought up interest rates before. There's a change at the Fed coming up. What do you think is going to happen with interest rates? And very briefly, are you concerned about politicization of the Fed with this change?
Yeah, so I think interest rates are going to remain similar to what they are now. I think there's too much uncertainty to lower at this point. I'm not a political expert and I don't want to represent KPMG's political position, so I'm going to abstain from commenting too much on the regime. I do think it's important that we have an independent body um, overseeing interest rates from the US government. So like I think everybody can agree that that independence is important so that we make decisions based on best policy, and but I don't expect interest rates, while there was a lot of hope in the beginning of the year, especially me because I'm trying to buy a house right now. I I don't expect interest rates to drop significally in the remainder of the year.
Thank you, Ryan, and good luck buying the house. Kevin, what do you think?
I think there's a decent chance that they will move lower, but I think it will be small increments and gradual.
Got it. Okay, well, final question here. An esteemed member of the audience that I know asked, what do you think of the future of SPACs? Kevin, why don't you start us off there?
Wow. Um,
Stumper for a closer there.
yeah, well, it's been such a roller coaster ride, you know. I mean, it's been flying high at times, and then they've been under attack at times. I mean, I think that people are continuing to look for creative ways to put capital to work. And so, you know, I think they will continue to be around, and I think it will continue to be a roller coaster where there will be some great successes and some big flameouts.
Ryan?
Hey, great. I mean, I was talking to someone at an event last night who is going through a SPAC. So they're happening still. I think they went horribly during the height of the pandemic when everybody was going for. I mean, you didn't hear SPAC 20 years ago. That was like not an in vogue thing. It will never go back to what it was in 2021, but we're going to continue to see them. And to Kevin's point, it's all built on putting capital work, and there is still entities that exist that value the public domain that don't have the product or the technology to support that offering anymore to provide access to that capital through a D-SPAC. We'll continue to see reverse mergers, D-SPACs, SPAC, like all those things will continue, but it won't be it's no one's first choice, I don't think. I don't know, Kevin, if you agree with that.
I
Yeah.
agree.
Well, thank you both so much. Thank you to our audience for joining us today. I just want to call out Kevin Stichter, partner at K&L Gates, and Ryan Breen, a partner at KPMG. We really appreciate you spending time with us today. I thank you all for being here. I'll pass it over to Don Aviv to close us out.
Thank you, everyone. Very, very important and insightful session. Thank you very much, Kevin, for the last minute entree in jumping in here, and Ryan, thanks as well. You guys are great. And to the audience, please send in your requests for sessions and what you're interested in, and we'll try to address that in the coming months. All the best.